Welcome, finance professionals. Today, we are exploring the intricate and high-stakes world of cross-border payments and collections. We will dissect the risks, the messaging backbones, and the modern strategies used by global treasuries to move capital efficiently. Let's get started. Welcome to Slide 1. Let's define the core of our topic. What are cross-border payments and collections? They are the financial transactions that occur across different national jurisdictions, usually involving currency conversions. The basics lie in the financial supply chain. As raw materials and goods flow in one direction, money must flow in the opposite direction. Why is this so crucial? Because as your corporation expands globally, securing the timely flow of capital to international suppliers and receiving collections from overseas customers is a matter of survival. How do we do this? We rely on a web of correspondent banks, clearinghouses, and global messaging networks. In our deep dive, we recognize that unlike a simple domestic transfer, international payments face friction from time zones, fluctuating exchange rates, and strict, sometimes conflicting, regulatory environments. This creates a breeding ground for delays and trapped cash. Looking at this diagram, we see the fundamental interaction between the physical and financial supply chains. On the left, we have a buyer in country A, and on the right, a seller in country B. The top arrow shows the physical movement of goods across borders. The middle arrow represents the invoice being sent. The bottom arrow is our focus today, the cross-border payment. This single arrow represents a complex journey through multiple banking systems, currency conversions, and regulatory checkpoints to finally settle the transaction. Moving to Slide 2, we examine the what and why of core cross-border risks. What are they? They are the severe uncertainties a firm faces when operating internationally. The basics include standard foreign exchange and credit risks. But why is cross-border risk uniquely dangerous? Because a sudden geopolitical event or a national debt crisis can cause a sovereign government to freeze capital flows, immediately trapping your company's cash. How does this happen? Primarily through two distinct mechanisms, convertibility risk and transferability risk. For our deep dive, let's distinguish the two. Convertibility risk occurs when a government bans the exchange of local currency into a foreign currency, like US dollars. Transferability risk is different. You might have the US dollars in your local account, but a new regulation suddenly prevents you from wiring that money across the border to your parent company. A strategic treasurer must plan for both. This flowchart maps out the anatomy of cross-border risk. From the top node, it splits into two distinct threats. On the left, convertibility risk, where the local government prevents you from converting local currency to foreign currency. On the right, transferability risk, where you cannot wire the funds out of the host country. Notice how both paths inevitably lead to the same disastrous bottom node, trapped liquidity. This chokes the financial supply chain and forces the parent company to seek expensive external funding. On Slide 3, we dive into the infrastructure, the SWIFT network. What is it? SWIFT is the secure global messaging backbone connecting thousands of financial institutions. The basics rely on standardized message types or MTs. If you want to make a cross-border payment, your bank sends an MT-103. If you want to see your daily balance, your bank sends you an MT-940. Why is this necessary? Because without a universal language, banks couldn't securely authenticate or route your billions of dollars. How does routing work? Using a unique SWIFT code, which is an 8 to 11 character string identifying the exact bank and branch anywhere in the world. Let's deep dive into operational efficiency. If your treasury sends a payment but leaves out the intermediary bank details, the message fails straight through processing and drops into a manual repair queue. If a bank has a 10% error rate on 10,000 daily payments, it requires dozens of staff just to fix typos. That massive operational cost is ultimately passed back to you, the corporate customer. Let's walk through a cross-border transaction using this sequence diagram. First, corporate treasury initiates the payment. The sending bank formats this into a standard MT-103 message and pushes it into the SWIFT network. SWIFT securely routes and authenticates this message to the receiving bank, which then credits the beneficiary's account. At the end of the day, the receiving bank generates an MT-940 statement, sending it back through SWIFT to the sending bank, which finally updates the corporate treasury's cash position. A seamless, secure loop. Slide 4 tackles the modernization of this plumbing, ISO 20022 and the CGI initiative. What is this? It's the migration from old text-based MT messages to rich, XML-based messaging. The basics revolve around the Common Global Implementation, or CGI. CGI allows you to use one standard message structure for every bank you deal with. Why do we need this? Because historically, every bank demanded a different, proprietary file format. Maintaining those custom interfaces was a costly IT nightmare. How is it solved? By using standard XML formats, like the Pain.001 for payment initiation. Look at the sample code concept. This XML snippet clearly defines the execution date, the currency, and the exact instructed amount. Our deep dive reveals the power of data overpopulation. With ISO 20022, your treasury management system sends one massive, data-rich file. Every global bank receives the same file, and their systems automatically filter out only the data they need. This drastically cuts IT costs and achieves true straight-through processing. This flowchart highlights the efficiency of the CGI standard. On the left, the corporate ERP generates a single ISO 20022 Pain.001 message. It hits the CGI standard node in the middle. Because it's universally accepted, this exact same file is routed simultaneously to global bank A, B, and C without any custom translation or formatting. The banks process the file and seamlessly drop the payments into the global clearing network on the right. One format, infinite reach. Let's explore how we mitigate these complexities on slide 5 using multilateral netting. What is it? It is the periodic net settlement of outstanding cross-border payments between your own corporate subsidiaries. The basics are simple. Instead of 50 subsidiaries paying each other back and forth, a central netting center calculates a single net payable or receivable for each. Why do we do this? To drastically slash the sheer volume of cross-border wire transfers and their expensive banking fees. How is it executed? By routing all intercompany invoices into your treasury management system, which performs the offsetting math. For our deep dive, let's look beyond just wire fees. Netting is a massive foreign exchange cost saver. If subsidiary A owes euros and subsidiary B is receiving euros, the netting center mathematically offsets these positions. You no longer have to go to the bank to buy and sell those euros, meaning you completely bypass the bank's bid-offer spread, saving millions in FX friction. This diagram visually proves the power of netting. Sub A owes 100K, Sub B owes 60K, and Sub C owes 40K. Without netting, we would have a chaotic web of multiple cross-border wires and FX conversions. With the central netting center in the middle, the system calculates the net positions. Sub A simply pays 40K. Sub C pays 40K. Sub B receives 100K. We have reduced multiple complex transactions down to just 3 simple, net cash movements. On slide 6, we address the ultimate cross-border fear, settlement risk, and how the CLS system solves it. What is CLS? The Continuous Link Settlement System is the global utility used to settle foreign exchange trades. The basics involve mitigating Herstat risk. This is the terrifying scenario where you pay your currency leg during your business hours, but your counterparty goes bankrupt before their time zone opens to pay you back. Why was CLS built? Because a massive default during settlement could trigger a systemic collapse of the global financial system. How does CLS protect us? By using a payment versus payment, or PVP mechanism. Both legs of the trade are settled simultaneously. Our deep dive reveals the mechanics. CLS operates during a highly specific 5-hour daily window when the real-time gross settlement systems of the major global currencies overlap. By matching and settling the trades simultaneously inside this window, CLS mathematically eliminates principal settlement risk. This diagram illustrates the payment versus payment mechanism of the CLS utility. Bank A on the left submits its USD payment. Bank B on the right submits its euro payment. Instead of sending funds directly to each other and risking a time zone default, both send funds into the CLS utility in the center. CLS holds the funds and executes a simultaneous transfer. Neither party gets paid unless both parties have funded their obligations. Absolute security. Let's apply this to a real-time use case on slide 7, navigating capital controls. What happens when your cash is trapped? Consider a global firm operating in emerging markets like China and Malaysia. The problem is severe. Strict capital controls create transferability risk. The local subsidiary is generating massive cash surpluses, but regulations prevent wiring those funds back to the global parent. Consequently, the parent company is forced to borrow externally at high interest rates just to fund operations. How does a strategic treasurer resolve this? First, by directly lobbying the local central banks for special exemptions based on their large corporate footprint. But where exemptions fail, the treasurer employs a technique called leading and lagging. They strategically accelerate, or lead, intercompany payables out of the restrictive country, while delaying, or lagging, the receivables flowing into it. The result, the firm legally extracts its liquidity, optimizing its global working capital, avoiding external debt, and remaining 100% compliant with local laws. Follow the decision tree for trapped cash. The process starts at the top with trapped cash in an emerging market. It moves to the regulatory engagement diamond. If an exemption is granted, you proceed left to standard repatriation. If denied, you pivot right and apply leading and lagging. This branches into accelerating payables out and delaying receivables in. Both tactical maneuvers bypass the blockage and successfully converge at the bottom, global liquidity optimized. Finally, on slide 8, we look to the future, AI and cross-border operations. What is the next frontier? It is the deployment of artificial intelligence to secure and optimize global flows. The basics involve moving away from manual compliance reviews toward predictive intelligence. Why is this urgent? Because the sheer volume of cross-border payments, combined with highly sophisticated fraud, requires a defense system that operates in milliseconds faster than any human team. How will this work? AI models are being trained on historical SWIFT messages, vendor data, and ERP cycles to understand what a normal payment looks like. Moving forward, if an invoice is submitted for an unusual amount or routed to an unexpected foreign jurisdiction, the AI will detect the anomaly and freeze the transaction instantly, preventing fraud before the funds ever leave the building. I invite all learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Our final diagram shows the AI security gateway. A global payment is initiated and immediately hits the AI machine learning engine. The AI acts as the ultimate gatekeeper. If the pattern is normal, the transaction takes the top path to straight-through processing. If an anomaly is detected, it drops to the lower path, the transaction is frozen, and a manual security review is triggered. Ultimately, this intelligent friction ensures that only legitimate transactions reach secure cross-border settlement.